Ind AS 103 business combination. Business is an integrated set of activities and activities and assets that are capable of being conducted and managed for the purpose of providing return in the form of dividend, lower cost, or other economic benefits directly to investor or other owners, members, and participants. So, business combination. So, first we are defining what is business. So, business is something that what rate of our money is coming in, then money is into business. What the investors get is dividend. Not only dividend, they get some or they able to invest something, they able to get something in a cost benefit or a good quality, or sometimes not. It's for non-profit. So non-profit for environmental or the social society. So this is the business. Dividend is money out. Business combination. Business combination is a transaction. Is a business combination is a transaction or other event in which acquirer obtains control over one or more businesses. Transaction sometimes it's a true merger or a merger of equals, or also a business combination as terms as the indies. What's business combination? What they're saying is one business one is taking over business two plus business three, then it's combination. Or sometimes the business one and business two, which equally get interest, equally they want to get like marriage, they want to do business, they combine themselves and become a business three. Ind AS 103 must be applied when accounting for business combination but does not apply to one forming a joint venture. Joint venture, it does not apply. A joint venture, they do not apply. And the acquirer of an acquisition of an asset or group of assets, that is not a business. Through general guidance provided on how such transaction should be counted. Like, so, taking over one to three assets. If you're taking one or two assets, the assets being take over means that is not acquisition, complete business. An acquisition by an investment entity is defined as the NDAs 110 consolidated financial statements of the investment in a subsidiary that is required to be measured the fair value of profit and loss account. Appendix 3 of NDAs 10. What is the saying is, for business one has 30%, 50%, 40% in A, C and D companies means this B controls 30 percentage of the 50% of C, 40% of D. Then what happened is in this case, when combining the balance sheet of B, we will see B plus 30 percentage of A plus 50 percentage of D plus 40 percentage of C. These all included to become the B. This is the consolidated financial statement that has been said here. And Appendix 3 of Ind AS 102 deals with the accounting of a combination of entities and business under the common control. Common control, who controls who? Because sometimes not even they get the shares, but they will have the board of directors. So out of the number of directors, they have the major holders. So they indirectly hold the board. So then after the controlling the board also says as a control. Determining whether transactions a business combination. A business combination can occurs in a various way by such a way of transferring cash, incurring liabilities, issuing equity instrument, or by combination therefore by any of the issuing or not by issuing consideration at all, by contract only. So cash, transferring cash, buying the shares. Buying is transferring. Liability means this company may got loan from them, but they are not able to repay. They are asking the shares or issuing equity instrument. Sometimes the company may even they may issue the equity. They will buy the share through a cash. Or this company will give share as beginning of amalgamation. So the one company will take over another company through combination of both shares. That's the amalgamation. But not issuing consideration at all. Now it's a contract hold. So we will have the control of this company for this many times, and we will do things. We will share the profits. Yeah, joint with like joint venture, but actually combination. Business combination can be structured by various way to satisfy the legal taxation. Other objective includes one entity becoming a subsidiary of another. The transfer of net assets from one entity to another or to new entity. Yeah, sometimes in a business combination, this will happen. One entity purely take the assets and they may sell it, or they will take the assets and bring it to the new organization, or they will take the total assets and liability and put it into a very new company, not in their own company, but in a new company and change the name. That's it. The business combination may involve the acquisition of the business, which generally have three elements: input, process, output. What is input? Economic resources, non-current assets, intellectual property that creates output when one or more processes are applied to it. Okay. The process, a system, standard, protocol, convention, or rule that may apply to an input or a input creates an output. A strategic business, operational process, or a resources management. What is the output? Output is a result of input and processing apply in result of the input and process applied to their inputs. So something you get a input, then you process it, then you get output. You acquisition method. The entity should account for each business combination by applying the acquisition method, which include identifying the acquirer, who is buying it, determine the acquisition, when is going to happen, recognizing and measuring the identifiable asset acquired and liabilities assumed and non-controlling interest in the what they acquired, recognizing and measuring the goodwill and gain from the bargain. So who, when, what, and so what they acquire, you see, then measuring the goodwill is what the gain they got from this one, because sometimes they will have a profit on acquisition. They may get the company shares for low cost. Low cost they may get the company shares, or sometimes they get very high cost. When they got high cost, they need to value the asset is 100 crores, but they pay 110 crores, means this 10 crores will go for goodwill. Yeah, we bought it in goodwill. So we think that it will worth more. So we bought 10 crores more. For them, it's a profit. But when you buy this in low, it's a profit actually. And the low, when you bought some 100 crores asset you have, but you bought for 90 crores, then what 10 crores is profit. That will be accounted in your profit and loss account. Yeah, some asset you buy it, which is a very less cost for the whole thing. It's a bargain gain lah. For each of the business combination. One of the combination entity should be identified as the acquirer. Mm. The acquirer should identify the acquisition date, which is the date on which it obtains control over the acquisition. Why this date is important? Because when you file the consolidated financial statement, you want to file the diluted shares, diluted earning per share. For the date is very important. For that, they are asking this. Recognition, measure my identifiable asset and acquire the liability. Acquire the liability, assume your non-control interest on the acquired. Recognizing and measuring the identifiable assets and acquired, identifiable assets acquired, liability assumed, and any non-controlling interest on acquired. This term you want to read. Recognizing principle. As per the acquisition date, the acquirer should recognize separately from the goodwill, the identifiable asset acquired, and the liability assumed, and any non-controlling interest in the acquired. For example, they got the company A. In the company A, have fixed assets. They have goodwill. Sorry, they have goodwill. This company even have goodwill, and they have what inventory, cash, bank, bonds, debentures. They have then they have shares too. Same times they have loans. Not only loans, they have debentures. They have issues debentures. They have then have what they have what liabilities, both short term and long term. Not only that, they have contingent liability. So when you see this, you can identify something. So what they can identify? You can identify what is the acquisition date. Acquire should know identify the acquired assets. What assets? Fixed assets, inventory, cash, bank balance, bonds, debenture, shares. These are assets. What is liability? Here you can see loans is liability, debenture is liability, liability short-term loan, long-term loan, and contingent liability is also liability because it is liability assumed for the sword that is liability assumed, and any non-controlling interest of acquiring. They have goodwill. So goodwill, what that goodwill means? They have some shares. So the shares they have some acquires in the acquiring. They have some non-controlling interest. Controlling interest, non-controlling interest is based upon the share base because if they have 20 percentage, 25 percentage, that is all normal interest. But when you have more than 50%, it's controlling interest. How that interest acquire, board of director, everything comes out. Measurement policies, measurement principles. The acquirer should measure the identifiable assets acquired and the liabilities assumed on as their acquisition date fair values. So we should know which date we need to acquire which date, such a dates. Acquirer should measure the acquisition date, components of non-controlling interest in the acquiree that are present, ownership interest, and entitle their holders to proportionate shares of the entities net asset in the event of liquidation, either in fair value or the present ownership instrument proportion share in the recognized amount of acquiring net identifiable assets. For example, they have a share in a company. Okay, it's a private company. What happens? Private company we can find only with the net worth. So net worth and what they invested. So investor and what invested is around 10 crores na. The net worth based upon the share it is as 12 crores na. You can either cash 10 crore as a nominal value or 12 crores based upon the net worth of the company. That is mean net present ownership instrument, proportionate share in the recognized amount of the acquired identifiable net assets. If not, sometimes you can say, sir, I want to see fair value. Fair value means they are holding around 10,000 shares. So based upon the value okay, 1 lakh shares we can have. 1 lakh shares they are having. They are saying 100 rupees per share, 100,000 rupees per share they pay at that time. Now the value is 1,300. So we can say 13 crores is the fair value. So we can say fair value 13 crores based upon the market price. So by calculating this only you can understand what is it. All other components of non-controlling interest should be measured at the acquisition date of fair values unless other measurement measures is required by the Ind AS. Exception to the recognized principle. Contingent liability. The acquirer recognizes a contingent liability assumed in the business combination at the acquisition date. If it is a present obligation, then arises from the past event and the fair value must be measured reliably. And even if it is not probable that outflow of resources embodied in economic benefits will be required to settle an obligation. So I said as previously, this contingent liability, na, it's a dangerous thing. Contingent liability. If a company has a liability, you want to see how far I need to settle this. There's 1 year or how many time it will take to settle this. We should see. And if it is within 1 year, we should say as contingent liability, current liability. and you should ready the amount. If not, there will be economic crisis in the company. If it's more than 5 years, also we should reliable opinion we should get. The opinion should state that this much amount will be required for settling this amount. So that is the thing. Contingent liability exceptions excepts to the both there is a recognition measurement principle. Income tax. The acquirer shall recognize and measure the deferred tax asset and liability arising from the asset acquired and liability assumed in the business combination, and account for the potential tax effects, the temporary differences, and carrying forward of the query that exists in the acquisition deed or arise as a result of the acquisition of Ind AS. You know about the deferred tax because of the depreciation and other expenses, deferred tax assets and liability acquired. So the acquirer when has deferred tax liability and the acquirer has a different tax asset, both get after the combination, both will get nullified. Some things will happen after combination. Sometimes they have both deferred tax liability and they have deferred tax liability. After the combination, deferred tax liability of the both companies will increase potentially because of the combination. So such a things are there. So we need to at the temporary difference, what can be carried forward, what can be carried forward. They need to say action. What tax regime they have following. They are following new regime or old regime. This will see as per the regime. They need to say is there the section 115 BBC. BBC is allowing to carry forward this deferred tax asset and liability, and what carry for the depreciation loss. All these things we should see. An employee's benefit. The acquirer shall recognize and measure the liability or assets, if any, related to the acquiring employee benefit arrangement in the accordance with the Ind AS 19 benefit. Employee benefit, what PF, bonus payable is there, and what gratuity, mainly in this, and ESI payments for industry. They have this liabilities. So and salary too. If then there is some assets payable, you should recognize properly as per the Ind AS 19. Indemnification of assets. If an indemnification results in to an assets or liability, the recognition of the acquired date and measure or at the acquisition date fair value. Acquirer shall recognize the indemnification asset at the acquisition date and measure it at the acquisition date fair value. The indemnification, okay, you see, this is very important. Sometimes a company may take over the company, another company. They may be not only have assets, they also have liabilities. Sometimes the assets which they thought they will bear it will may not be the asset what there is in books. Bad debts may comes and creditors may impose interest. There are many problems, but such things also be to consider. Leases in which acquiree is a lease. The acquirer shall recognize a right to use asset and lease liability of the lease is identified in the accordance with the Ind AS 116 and leases in which acquiree of the license. So when the company is acquiring something, they are in a building that acquirer counts at acquiree who is giving the company who is in the rented leased building. So then after the acquisition, the acquired company became the lease owner. I don't want to explain this. You can what are the difficult concept I can say. Acquire shall measure the lease liability at the present value at the measuring the lease payment present value, or remaining lease payment if the acquiring lease were a new lease and acquired it. The acquirer shall measure the right use of asset at the same amount as the lease liability, adjust to reflect the favorable and unfavorable terms of the lease when compared with the market terms. So he is comparing with this whether this lease is benefit or not. Also, they are seeing the rent what they pay, the lease amount what they pay, is market viable or not. Exception to measurement principle. Reacquiring rights. The acquirer shall measure the value of the reacquired rights recognized as an intangible assets on the basis of remaining contractual terms for the related contract, regardless of whether the market participation would whether potential contract renewals when measuring the true value. So usually this is the acquired rights will be considered as an intangible asset. But in the case of contract, the related contract would be considered as a potential contract renewal. It means a fair value. It's an exemption. Share-based payments. Acquirer shall measure the liability of an entity instrument related to share-based payments. transaction acquire or the replacement of the acquire share-based payment transaction with the share-based payment transaction of the acquirer in accordance with the method of Ind AS 102 share-based payments. Because when they acquire, they say we give 10,000 shares, we will give to you. Each share will cost you 130 rupees. Such a way they say, no? This share, this payment, what they saying is to be paid, going to be paid to them. So who going to get the shares? Who, what are the shareholders going to get the share? Or the creditors going to get, um, or who, or the debenture holders get the how much they would. All these things, preferential debentures, convertible debentures, everything to be analyzed based on share-based payment. Asset held for sale. An acquirer shall measure an acquiring non-current asset or disposal group that is classified that is held for sale at the acquisition date. In accordance with NDS 105, non-current asset held for sale and discontinued operation, the fair value or less cost to sell. Sometimes the company what they're taking, they may have to sell some asset on the day of acquisition. They know that, but what you know should you should inform us. You should incur us for selling this asset how much it will cost. That you should recognize as an expense because you can on the day you know that they're going to sell it. So something so on your acquisition cost you can include that because that is a cost they could so you no need to pay that because that become obligation when you do an acquisition date. You don't need to bear that cost. You can fair value less the cost to sell and you can remove recognition and measurement of goodwill or gain from bargain purchase. Goodwill is measured as a difference between the consideration transferred in exchange for the net of the acquisition date of amount of intangible asset acquired and the liability assumed. Yeah, the cost of the company is 100 crores. As I say early, you bought for 110 crores. 10 crores is on goodwill. Same thing, bargain purchase. And the extreme rare circumstances, the acquirer will make a bargain purchase in the business combination, where a value of acquired identified assets and liability exceeds the consideration transfer. Acquirer shall recognize the bargain gain as recognized gain on the bargain purchase. The gain shall be recognized by the acquirer in the other comprehensive other comprehensive income. On the acquired date and accumulate the same in a equity as a capital reserve. So, and because what happens is you bought as a gain for you. At the same time, what is that gain? How is going to it? It will be reflected on the capital reserve. You bought for 110 crores. You asset value is 100 crores, and you bought for 90 crores. Now, books how you show na asset side 100 crores, 10 crores as capital reserve. Asset is so if this exists in the clear evidence for the underlying reason for classifying the business combination in the bargain, which is you don't need to show the asset in the what purchase rate. You can show it in the fair cost, fair value. You're revaluating the asset on the day of entering into the book. That's what it said. If it does not exist clear evidence of underlying asset for classifying the business combination as a bargain purchase, then the gain must be recognized directly in equity as a capital reserve. So if not able to find the classifying, no, they can directly equate it to capital reserve. Reverse acquisition. Reverse acquisition. A reverse acquisition occurs when an entity that issues securities, the legal acquirer, is identified as the acquiree of the accounting. Entities whose equity interest are acquired, the legal acquirer must be the acquirer for the accounting purpose for the transaction to be considered as a reverse acquisition. So who we acquire as the case became the acquiree. Due to some legal issues, they may do that. Okay. Applying the acquisition methods to a particular type of business combination. A business combination is achieved in stages. Okay. What stages? Acquirer shall measure the previous held equity, interest in the acquiree at the acquisition date, fair value, and recognize the resulting gain or resulting loss or profit, gain, resulting gain or loss in the profit and loss or other comprehensive income as appropriate. Okay. Business combination achieved without transfer of consideration. Acquire shall attribute to the owners because before it is want to see what is the equity, what is the holding assets and liability, what is the profit and loss account, what is the other comprehensive income. In this case, the company, business company actually without the transfer consideration, there's no causes involved. So acquire shall attribute the owner of the acquire the amount of acquired net asset are recognized as per the Ind AS. In other words, entity interest in the acquire held by the parties other than the acquirer, non-controlling interest in the acquirer post combination financial statement, even if the result is that all the entities interest of the acquirer are attributable to non-controlling interest. Mm, The equity interest of the acquirer held by the parties other than the acquired is non-controlling interest. An acquirer post combination statement, even result is that all the equity interest in the acquirer is attributed to non-controlling interest. So they may have shares in various companies, but their shares are not viable for control. Measurement period. If an initial accounting of a business combination is complete by the end of the reporting period in which a combination occurs, acquirer shall report the financial statement providing amounts of the item of for which accounting is incomplete. Okay, provisional amounts for the amount. So he may give two amounts, provisional or actual. So if it is the end of the accounting period, he will say provisional amount. During the measurement period, the acquirer shall retrospectively adjust the provisional amounts recognized, additional assets and liabilities that exist on the acquiring date to reflect the new information obtained. Okay. The measurement period ends as soon as the acquirer receives the information it was seeking. It is seeking about the facts and circumstances that exist as the acquirer date or learns that more information is not obtainable. However, the measurement period shall not exceed 1 year from the acquisition. So they are giving so from the date of acquisition, they are giving 1 year time to complete the accounting. Yeah. Segment measurement and accounting specific items. In general, acquirer shall subsequently measure and account for assets acquired, liability assumed and incurred, and equity instrument issued in the business combination in accordance with the NDAs for the items depending on the nature. The NDAs 103 provides guidance on the subsequent measures and accounting for the following assets acquired: liability assumed, liability incurred, or equity instrument issued. Reacquired rights, contingent liability records, acquisition date, indemnified assets, and contingent considerations. So, what are the disclosure to be given? An acquirer shall disclose the information of business combination that contains either during the current period or over end of the reporting period, but before the financial statements are approved for usage. The standard require acquirer to disclose information that each business combinations that occurs during the reporting period, such as a name and the description of the acquiree, who has declared, which period it came, and what is the acquisition date, the percentage of voting of equity interest acquired, how much they have voted, and other disclosure prescribed in the standard. Business combination of entities and other common control. Common control. The common control business combination means a business combination involves entities and business in which all the combined entities or the businesses combining business are ultimately controlled by same parties, both before and after the business combination. And that control is it's not transitory. Transitory. Example, A company, B company, C, D, many companies are there. Here, B company is taking over D company. But things at B and D are company, great thing. But at last we see all these companies are controlled by X, Y, Z. So what is the news? That's the thing. A business combination involves entity or a business under the common control shall be accounted for using the pooling interest method. Pooling interest method. So how much they hold, where are they hold. The pooling of interest method is considered to involve the following. Assets and liabilities of the combining entities are reflected at the carrying amount. What is the carrying amount? That is reflecting it. What is the net worth value or fair value? Net worth or fair value. And no adjustments are made to reflect the fair values or recognized any new assets and liability. The only adjustment that are made are to harmonize accounting policy. So the net worth you can use, but not fair value. They are saying the financial information in the financial statement in the respect of the prior period should be restated as if the business combination had occurred for the beginning of the preceding year at the financial statement, irrespective of the actual date of acquisition. So in the pooling of assets, even though they acquire, that is nothing. Whatever previously was held will be considered. However, if a business combination occurred after the date, the prior period information shall be restated only from that date. Okay. As a consideration for business combination, security shall be recorded at nominal value. Nominal value, what value they invest, that is the value. And assets and other cash should be considered at the fair values. They should not do this pooling. They should not overvalues or revalue it. Or revaluation is not allowed. The business of a retained earning appearing in the financial statements of the transfer is aggregate with the corresponding balance appearing in the financial statement of the transferee. So A and A became B. A has 100 crores now. After B, 100 plus the B company should be there, not more than that. Alternative, it is transferred to the general reserve if any. Sometimes they can transfer the revenue returning to general reserve. Okay. The entity of the reserve shall be preserved and shall appear in the financial statements of the transferee in the same form in which they appeared in the financial statement of the transfer. So, the person, both the statements should be same. They're saying okay. In difference, if any of the difference, if any between the amount recorded in the share capital issued plus additional consideration in form of cash or other assets and the amount of share capital of transfer shall be transferred to capital reserve and should be presented separately for other capital reserve. The disclosure of its nature and purpose of the notes. Sometimes there is a change, a transfer of cash or transfer to capital reserve something. We should say what is the why it is transferred, what is the purpose of it should be explained. Following disclosure shall be made in the following financial statement following the business combination. Name, general nature of business, combined entity. So who bought who and what is their business. Oh, that is too important. The date on which the transfer obtains date or what is the date they acquired it. Describing number of share issued, and together with the percentage of entities equity shares exchanged to affect the business ownership. So how many shares they issued and how many percentage they have, both. That they should A this much, B this much. The amount of the difference between consideration, amount of any difference between the consideration, the value of net identifiable asset acquired, and treatment therefore. So if any net identifiable assets are acquired, and how they are treated, what did they do, that they should mention in the report. This is the complete thing for Ind AS business combination. Not three. Thank you.